right, that should be popping up now. Let me do this. All right, so we all know why we're here. We're here to talk about the employer grant. I will be your host through this session. I'm Amanda Ludwig. Just a brief history on why I'm here. You shared with me why you're here, and I appreciate that. So my background, I co-founded a nonprofit organization. I was a school administrator, and I also have owned a business consulting firm specializing in accounting and CFO outsourced work. So when this program is really the kind of connection of all of my worlds of me enjoying being an educator, but my understanding of accounting coming together. And so I really, really enjoy that. And interestingly enough, this grant is open to for-profit businesses also, if they struggled during COVID. This is not exclusive to nonprofits, but I really wanted to put together a webinar just for my nonprofit folks, because it's one, I love what I do, right? I love being able to share this with people. I feel like it brings me a great sense of purpose and community when I'm able to help folks with this program. But because of my nonprofit background, I also know there's so many causes, ones that I'm passionate about, ones that I don't even know about, and funding and fundraising is always on the mind if you're part of a nonprofit. And so I wanted to put together a webinar just for my nonprofit folks. And secretly, well, I guess it's not a secret now because I'm going to tell you, but I've set a goal that we are going to raise $2 million through this webinar. Today, the goal is $2 million through this webinar. It's totally doable. I calculated it because I'm an accountant, that's what we do, to come up with that number. But when I think about that, when I think about helping collectively you folks raise, we're going to say raise, $2 million, that again gives me a great sense of purpose and pride in what I'm sharing with you and what I'm doing. So, so that's just a little background on me and why I'm here, but you didn't come here to learn all about me, you came to learn about the grant. So let's dive in. Couple of goals for today, in addition to the $2 million. We want to, of course, define what this program is. And then a really big piece is bringing clarity to misinformation. So a huge challenge I have when I'm educating people about this program is helping them overcome having been misinformed in the past. So some of you have heard about the program already, as indicated by our polls. So some of you, this is a brand new concept. Some of you have heard about it, but the information you heard may not have been accurate. I would say likely was inaccurate, just based on my experience in educating folks. And then of course, we want to spend some time on eligibility and then next steps to get your application launched. All right, so right off the bat, the definition of the employer grant, I need to give you a little terminology here. So when I use the word employer grant, ERC, or ERTC, those are all interchangeable. And of course, ERTC stands for Employee Retention Tax Credit. Now, you may have heard commercials about the ERC and, you know, kind of cheesy, you know, we're going to get you a lot of money kind of things. And so we want to clear up, again, some of the misunderstandings about how this program works. But just keep in mind, whether I use the word ERC or employer grant, we're talking about the same thing. So now that we've cleared up the terminology, let's talk about the program. So the ERC was introduced by the CARES Act. Most people don't realize this or remember this being part of the CARES Act because the really dominant piece of the CARES Act was PPP. So that's what everybody remembers from that time. That's what everyone was focused on. And like PPP, it was designed to keep people employed during COVID. That was the entire point of this program. But at the time when the program came out, and I'm just going to let you know why you didn't hear about it. At the time it came out, you had to choose between PPP or the employer grant. You weren't allowed to do both. And because most people were more comfortable with PPP, right? Because PPP, it went through your local bank, and which is a place you have a relationship already. And some of the terms and things like that, people were more comfortable with PPP. But the primary reason I believe that people wound up doing PPP rather than ERC is because it was more publicized in the media. I mean, that's all we heard about was PPP. In fact, that's all I was talking about. I was doing, going on radio programs and doing YouTube videos talking about PPP and EIDL and, how to qualify, how to watch out for scams. I mean, I covered that really detailed, but I didn't cover the ERC because, again, if you had to choose between the two at the time, stick with me for a little bit. If you got PPP, don't leave the webinar yet. You had to choose between the two. And in doing so, because most people went PPP, we just stopped talking about ERC. And then there was a sneaky thing that happened later on. There was an expansion of this program that was under the Consolidated Appropriations Act of 2021. Most of us don't even, we all remember CARES Act, the CAA, ARPA, those are not as fresh on the mind. But what's important to know, and you can look up these acts if that's important to you, but what's important to know is the program eligibility expanded and the timelines got expanded. So it opened this program up to so many more people, but no one was talking about it. That's why we're here today. So again, keeping on with our definition, it is a stimulus program, but it is a grant, not a loan. So some similarity with PPP, but this is entirely a grant. It is not a forgivable loan. PPP, of course, was a loan, and then most people got it forgiven. This program is issued from the beginning as a grant, no payback. It's based on qualified wages, which we'll define. There is no limit on funding. So $400 billion was set aside for this program. But unlike the PPP frenzy where, they're running out of money and you've got to get your application in, this program is date driven rather than fund driven. So there's a deadline, there's a specific date by which we have to get our applications in. And I should mention the last update that I got, which has been a few months now, but the last update I got was that it was estimated that only about 10% of folks had applied for this as of a few months ago. Again, not highly publicized. A lot of people don't know about it. A lot of people don't understand the eligibility. So there's this huge amount of funding sitting there, and no one's claiming it. So again, that's what makes what I'm doing really, really fun for me. So keep in mind, it's a refundable tax credit. And I want to pause there and say, most of the time when we're thinking nonprofit, tax credits are not something that appeals to us in the nonprofit world, right? They don't benefit us if we don't pay taxes. But keep in mind that even though nonprofits don't pay income tax, you do pay payroll tax. So because you pay payroll tax, and this is a payroll tax credit, you are eligible and it does still benefit you. But what's better about this program than PPP, this is why I prefer ERC over PPP personally, is because unlike PPP, these funds are unrestricted. PPP, you had to spend it on payroll and you had to spend it on rent, utilities. There were very specific qualifications of how you could spend the money. Any part of the money that wasn't spent on those things, they were saying it won't be forgiven. This program, because it's a refund of your money, so you sent money to the IRS, they're sending it back to you. It's essentially your money. It was your money to begin with. They're sending it back, much like when you get your W-2 and you file your tax return at the end of the year, right? If you paid in too much taxes, they give you a refund. This program, at its very, very limited description of it, that's how it functions. So because of that, we have to think of these funds as unrestricted. They can be used for any program. They can be set aside for a later time. They can be just put into an as needed. However your board decides they should be spent, there is no restriction on the spending, and there's no post-award reporting. So how you've spent the money, you do not have to send a report back to specify how you spent the money. There's no tracking for this. So that's why I love it. It's why I think it's such a great fit for nonprofit organizations, because so often you receive grants, right, that you really need and help your program, but sometimes you have another need that is not really grant worthy, fixing a building or something like that, maybe there's not as much grant funding available for, and donors are not as passionate about, a leaking roof as they are about maybe the programs that happen under the roof. And so this is a really great, I think, a really great program especially for nonprofits, because you can use the funds as you see fit. So now we need to jump into the misinformation section. Before we do, I'd love for you to have something to write with, to be able to take a couple of notes. I am going to ask you to jot down a few things. Before we get into eligibility, I want to give a couple of things that aren't in the presentation, that when we get to some information, I'm going to define them further. But if you want to jot these down as far as to have on your mind for eligibility, who is eligible in general. US based, right? Because this is a refund of payroll and payroll taxes. So if you paid payroll taxes in the US, great. You can check that box on your list that you qualify. Non-government. So this is it. You can't be fully funded by the government. If you're fully funded by the government, considering this is a government program, they consider that sort of a double dipping. If you're partially funded by the government, that's something that is definitely worth looking at, but exempt are fully funded government organizations. And then another piece I want to clarify, because I may mention this and I need to tell you that it's a little broader than how I will mention it. 5 to 500 employees is what we're looking at. Now, that is not the only rule. It's just that the rules that we're talking about today apply to 5 to 500 employees, right? If you have more than 500 employees, you are not excluded from this program. There's just a different set of rules that apply to you. So many of the eligibility things we're going to talk about apply to you, but a few won't, or a few you actually have some additional things as a larger employer, excuse me. And so I think that that's important to note, again, that what we're talking about is for organizations between 5 and 500. If you fall outside of that, then there's a few changes for you. So I think that's important to note as we go down through this misinformation. All right, so number one, this is a list of things that folks have told me when I've spoken to them about this program. Okay, so other businesses and organizations, these are their experiences that I charted. So the first one is, if we apply, we will get audited. And I can tell you that the audit rate for these applications is 1 in 10,000, very minimal audit rate. And if your application is accurate, and within the guidelines, then an audit is less important, right? You can be audited and pass the audit, right? So I think that shouldn't be the top of our concerns. We have too many or too few employees to qualify. Again, we're looking at a huge range, 5 to 500. And outside of that range, there's also some other guidelines that we need to consider. The program ended in 2021. This is true, but not true. Originally, it was set to end, but of course, because of the changes, it was extended. So the deadline has extended. The program, although it is a program for 2020 and 2021, the deadline to apply has been extended, and we'll look at deadlines. Huge one. This one is, we did not have the required decline in revenue. Again, when the program came out, you did have to have a decline in revenue to be able to apply. That is no longer the case. You can use that as a qualifier. That's an easy qualifier if you know you have that. But if you don't have that, we need to look at some of the additional eligibility that is available to you because of the changes that happened after the program initially came out. The next one I hear a lot, we did not shut down 100% during COVID. Don't have to have 100% closure, and I'll share with you kind of some of the exceptions to that. We received PPP, so we don't qualify. Again, very common. And I know that when someone says that to me, that they're looking at the old eligibility rules, because this is actually what I've posted on the screen is a screenshot from the IRS's website. And if you notice, this was after the changes were implemented. You'll see here that they reference a notice that explains when and how employers that received a PPP loan can claim the employee retention credit for 2020. So that's that I can't do this because I did PPP. You were right at one time, but now that the rules have changed, we need to go back and check your eligibility again. All right, and then here is probably the most common objection I hear, and so we're going to overcome that today. My CPA or attorney told me I don't qualify. And I get that, because again, if they read the original CARES Act, which most CPAs and attorneys would have at the time, because a lot was changing in the country. But if it's not their specialty to work on this program, it's highly unlikely that they were interested in the later acts that came out. So they're not lying to you. It was true when the CARES Act came out. So we'll give them that credit. But again, there's some later information. So if your attorney or your CPA told you that you don't qualify, let's look at some additional eligibility and see if they were following the old guidelines. Another objection, and this is really specific to accountants, I think, accountants, we like our 2 + 2 = 4 and our balance sheets to balance, right? We're very black and white. And so there is this, what we're calling the quantitative versus qualitative dilemma, where the application can either be for a decline in revenue, which is very cut and dry, black and white, the numbers tell the story, or the other qualifier is a narrative. And accountants were less comfortable with feeling like a narrative is acceptable. It's just words, it's just telling the story of what happened during COVID. And so a lot of accountants are uncomfortable with that part. It's perfectly legitimate. It is in the IRS guidelines, but not what CPAs are used to working with. Now, if you're a grant writer, I know we have some grant writers on today, you're used to having to present information, a narrative, and financial information together in a grant proposal. That's pretty typical. And so that's sort of a similar concept to how this application is prepared, with keeping in mind there is a story that goes with it, a narrative, and then also, of course, a financial calculation. Another reason is that it's not lucrative. It's very expensive to get your entire staff trained on a product that is going to go away. So unlike income taxes that are going to probably be here forever, and that's what most CPA firms are focused on, this is a program it's a short term. So the investment in learning it, getting your entire staff up to date is just not ideal for most firms. And then the biggest one, well, maybe not the biggest one, but one I've been hearing about a lot lately is accountants are concerned about the IRS Dirty Dozen. If you're not familiar with the Dirty Dozen, that's a statement, the 2023 Dirty Dozen. The IRS listed the top sort of 12 scams and things to look out for, from the IRS's standpoint. Number one on the list was the employee retention credit. So that's been a big red flag for a lot of accountants. Don't do this program. The reality is, if you want to read this statement while it's on the screen, the reality is the IRS wasn't telling people not to apply. Rather, this made the Dirty Dozen list because there's a lot of scammers and there's a lot of very aggressive companies trying to sign people up for this program, and they aren't being truthful about eligibility, And some are even using the collection of all of the data to conduct identity theft. So that's why it hit the Dirty Dozen list, not because the program is bad. It's an IRS program, so they can't say their own program is bad. But also, really the focus of that was this statement here. So now we need to move on to how do I actually qualify? So I'm going to get out of the way here for a minute, and I am going to have you read that while I look at some of our Q&A. All right, so if you think one of those two qualifiers may apply to you, go ahead and give me a thumbs up. We are going to further define what those qualifiers are, especially because, okay, a couple of thumbs up. Okay, good. Some folks have already identified that they may have a qualifier. This is great. So let's define these a little bit further. And so the first one is the gross receipts reduction. This is basically the formula is, and again, if you choose to go further with this process, we can go into more detail, but you're going to compare 2020 and 2019 quarter by quarter and look for a 50% decrease. So quarter 3 of 2019 to quarter 3 of 2020, did any quarter decrease by 50%? Same thing for 2021, quarter 3 of 2019 to quarter 3 of 2021, and we only need a 20% decrease. If you hit either of those, that is your qualifier. It's important to note that you can be eligible for one quarter and not another. Next one, this is why I want you to have your pen and paper, because we're getting closer to the end and I need you to write down a few things. So if you don't have the revenue decline qualifier, you can qualify with the narrative. The narrative is a change in business operations. This is a list of some that have been used that the IRS has accepted. So I want you to scan down through them and jot down a couple that apply to you. The good news is you only need one. So it's not 3 out of 10, you only need one. And this is not an exhaustive list of qualifiers, but it's enough it should be enough to get your mind going. And I want you to write it down while it's fresh on your mind, so that you'll have that in your memory bank for your application. So partial or full suspension of operations, if there was a government order in your state that said you couldn't operate, that's an automatic. That's the easiest qualifier because the government said you couldn't be open. If supplies couldn't get to you, if there's materials you need to do your operations and your vendors were having difficulty supplying you, that's a qualifier. If you continued to be open, but you had to reduce the services that you offer because of social distancing or any other things that were part of COVID, that can be a qualifier. So scan down through those, jot down any that apply to you, and I've got another page as well. All right, let's skip forward to the next one. A really common one is additional spacing requirements. So if you couldn't do what you normally do because of social distancing, that can be a qualifier. Another one I just heard the other day, the tasks or work that couldn't be done from home. There's an organization that does pottery making classes. Well, you can't do a pottery making class on Zoom. So that's a qualifier for them. So think through those things. I will send you a list after the webinar, but while it's fresh on your mind, write down the one that you think applies to you. If you've got a couple, great, jot them down. And let's talk about the full or partial suspension, because again, a lot of people think they aren't going to qualify because they didn't close down 100%. But what the IRS specifies is they're looking for nominal impact. And the definition of that is a greater than 10% impact on sales or hours for that particular part of the business, which is often misconceived as you must have a 10% reduction in revenue, when the reality is it's the shutdown is 10% of your revenue producing operations. So think of something that impacted some part of COVID that impacted more than 10% of your operations. And if that wasn't on the list from before, jot that down now as well. And so, and actually this is the wrong header, my fault. This is the other qualifier, not gross receipts. So I want you to read this question. And if the answer to this question is yes, then I want you to give me a thumbs up. Let's see how many people are able to answer this question, that you had 10%, a 10% impact on your organization. Okay, whether that was staff, whether that was your service to your members, whether that was a social distancing thing. Good, lots and lots of thumbs up. Most people had a nominal impact and are able to qualify in that way. So I'm so happy. I'm sad that you were impacted, but now I'm happy that that you're finding those things that are going to help you to qualify. Couple quick hitters about eligibility. Can I apply for the ERC with 1099 workers? And the answer is no. We're looking for W-2 employees rather than subcontractors. So when you count the number of employees, make sure we're talking about W-2 employees. Qualified wages definition, that is any wages that are subject to FICA tax. So the matching taxes that you have to pay on your 941, that's what we're talking about with qualified wages. If you're not sure what I'm talking about FICA tax and 941, hop on with me after so we can give that a little bit of a more defined definition. The period the program covers, we're looking at March 13th of 2020 through September 30th of 2021. Those are the quarters that are covered by this program. Program does end. I mentioned it's deadline driven. We need to have applications in. We've got almost a year to apply for 2020 and an additional year for 2021, but you don't have to wait. You apply for all quarters at the same time, ideally before the first deadline. Part-time employees do count, but they will count as a half. So when you're considering your number of employees, consider each part-time employee as 0.5 when you're adding them together. So if you have 10 part-time employees, consider them as 5 full-time employees, roughly for calculation purposes. Now, the part everybody's been waiting for, and good, because we're getting close to wrapping up. So how much money can we apply for? You've probably heard it can be up to $26,000 per employee. But there's some deductions and there's some calculations you need to know about. Number one, if you got PPP, then you can't use this money and your PPP money for the same date range. So you can't double dip or overlap that funding, but you can still get funding, just not for that specific date range. For 2020, you can claim up to 50% of the wages that were paid, with a maximum credit of $5,000 per employee for the entire year. Do some quick math in your head. How many employees did you have in 2020? Multiply that times 5,000. That's a good broad number to consider. 2021, it ups to 70% of qualified wages. And in 2021, it's 21,000 per employee for the year, but that's broken up as 7,000 per quarter for 3 quarters. And again, you can qualify for 1 quarter and not another. So if you qualify 2020 and first quarter of 2021, you could guesstimate that at $12,000 per employee. I will tell you the national average is $10,000 per employee. However, most of the clients that I've been working with, I'm seeing that number be a little bit higher. Is anybody excited about these figures? Hopefully you're doing some math in your head. Again, rough estimates, then we need to consider PPP. But I think that to me, that's really exciting when we get to that point. So quick hitters here. Good, I'm seeing some thumbs up. All right, so significant returns. This, if you got PPP, this is a pretty safe guideline. If you got PPP, so $26,000 per employee is the target. That's the highest number. If you got both PPPs, you could consider between 6 and 10,000. If you got PPP, just PPP 1, 10 to 15. If you did not accept PPP, you can look at 15 to 26,000 per employee. So this is a really significant amount of money to consider. So again, no limit on funding. We're looking at 2020 and 2021. And we can qualify with either decreased revenue or partial or full shutdown of business operations. So that's given you the total overview. I think we've determined that several people qualify. If you don't believe you qualify, let's chat. And I'm going to give you some guidance too, as if you need to present this information for other people. But the time is 12:46. So for those of you who do need to hop off the call, I understand. We're going to keep going because the next round I want to talk about is actually how to work with someone to apply for the funding. And when I say work with someone, I'll just tell you I'm an accountant and I outsource 100% of this work. I work with a company that has CPAs and lawyers on staff, and this is all they do. They have a department that only works with this program. So even me as an accountant, I didn't prepare my own application. The information is like 170 pages. And when I saw this, what's on your screen right now, and I start reading government orders, affiliation rules, international, oh yeah, of course, furloughed employees and employees paid while not working. I have to know about that. I started reading down through all of these and I said, there's people who can do this better than me. And that's who should be preparing this for my clients. And so I partner with a company that will prepare this application. So if you want to know about that, I'm going to continue presenting about working with them, what that looks like, what the process is, and really more diving in a little bit more into the application with timelines. So for those of you who have to hop off the call, then I understand. For those of you who are interested in moving forward because you believe you may be eligible, then I want to encourage you to stick around for a little bit longer and let's finish up this portion. All right, so the company I choose to partner with, and again, I've chosen to partner with them. I do not work for Bottom Line Concepts. I am not an employee of Bottom Line Concepts. But the company I chose, Bottom Line Concepts, is the #1 company in the country doing this type of work, doing the ERC program. They are not one of these pop-up companies that the IRS Dirty Dozen was referring to. This company has been around for 14 years. They have recovered over $5 billion for clients. EY, which is a Big 4 accounting firm, works with them. So I feel confident in their work. They've done this for the ERC application for more than 30,000 clients. But the part that people usually like the most, all of those numbers are important to me, but what people usually like the most is that they charge no upfront fees. Their rule is they don't get paid until you get your refund. So they do the work, they put in a lot of time and energy. And then when you've got the checks in the mail, that is when you'll get the invoice from them. So to me, that was a really important thing for clients. And so again, another advantage of partnering with them. If you're curious who else they work with, here's just a kind of a quick snapshot of organizations that have worked with Bottom Line Concepts over the years. Several of those will be, I'm sure, familiar to you, and maybe organizations kind of doing, have a similar mission to some folks that are on the call today. And so let's talk about refund amounts. The very first, and these are actual ERC clients, of course, I can't share who the clients are, but this first one, this is one of my clients. The very first organization I helped was a faith-based organization. And this is the amount that they received. They only had 6 employees. So as you can imagine, for a smaller faith-based organization, this was an impacting number. but the numbers really do range. We're seeing 7 million, 3 million. The numbers vary and they can be quite significant. The important piece to note is, of course, how many employees and whether or not you received PPP. So let's talk about their process briefly. The first thing that you'll do is a consultation. So today is education. Next is consultation. You'll actually get an ERC advisor. It is absolutely free to speak with them. The call takes about 15 minutes. And they're going to review how you qualify. That's why I wanted you to jot those things down so you'll be ready for that call. You really don't need anything else other than telling your story about COVID and roughly how many employees that you were able to keep employed in 2020 and 2021. After your consult call, they will send you an engagement letter and a complete questionnaire. Again, some of the things we've talked about today are what goes on that questionnaire. It's not difficult to fill out. It's mostly information that you would already have. Don't be scared of the engagement letter. So a lot of times folks are a little bit leery of the engagement letter because they're not certain at this point at step 2, whether or not they're going to move forward. They don't know how much they're going to qualify for. And so this is a little bit intimidating to some people. I will tell you, bottom line, again, why I like working with them as a company, bottom line is 100% contingency based, as in they cannot send you a bill unless you get funded. So if you decide at steps 1, 2, or 3 not to move forward, that's okay. You don't owe them anything. They will, by the end of step 3, this is what they will have done for you for absolutely no cost. They will have done a consultation call with you to review your eligibility. They will have calculated, so you'll supply them with some documents, 941s, your PPP forgiveness, all stuff that you would have, and they will run the calculation and tell you the exact amount you qualify for. And at that point, they've done all of that work and you still haven't paid them anything, nor do you owe them anything at that point. That's the juncture where you can decide whether or not you want to move forward. I've never had anyone not move forward, particularly with the numbers they qualify for. Usually it's more like they're calling me and I'm getting, it's exciting and, oh man, we're getting $200,000, $300,000, $400,000, and that's usually the reaction after step 3. But again, I want to be clear that you do have options still at that point. At 4, they're going to ask you to sign your amended 941, and then they will submit it to the IRS. The stage between step 2 and step 3 takes about 3 weeks. So from the time that you submit all of your information, it will take them roughly 3 weeks to do your calculations. Then once the documents are sent to the IRS, you can expect checks in the mail between 3 and 5 months from that point. Again, we're waiting on the IRS. I will say I have met some folks who self-prepared their ERC, and they've been waiting more than a year to get their funding back. The IRS hasn't even finished processing their application. So I can say an advantage of working with a company who really knows what they're doing is that their application process is streamlined. They format it exactly how the IRS wants to see it, and it moves very, very quickly. So again, refunds in 3 to 5 months. Now, I'm sure everyone has the question of how much do they charge? And it is contingency based, as in it is a percentage of the amount that you qualify for. That is their fee that you will owe them after you get the funding. But that's also something that will be discussed in your consultation call and will be fully disclosed in your engagement letter. So your consultation call will help them to determine on their sliding scale the rate that they will be charging you, the percentage, and then it will be confirmed in the engagement letter. So you'll have that in writing before we move forward. All right, so now that we've gotten through that bit, I imagine folks have questions about that piece. So I'm going to look through these questions real quick, and then we're going to break out. For additional questions where we can actually speak to each other. So we need to just hop on another Zoom to be able to do that. So this is what I would ask. If you have additional questions that you would like to go over today, I'm making myself available to answer those questions. If you would, go ahead and put your email address into the chat. I'm going to copy and paste that over into an invite, and you'll have that within just a minute or two. You'll have that invite to hop on those additional questions. Of course, if you don't have time to continue the conversation today, you're going to get a lot of emails from me. So a couple of different things are going to happen. You're going to get a link to this recording. You're going to get some materials, some handouts. If you need to give this information to your board, to your treasurer, if there's someone else that needs to be involved in the decision to make the next step, then I'm going to give you information to give to them. I'm also going to send you a series of informational emails that will be very easy to forward, because it's going to be quick recaps, short recaps of some of the things that we talked about today. For example, there's one that's about, can I get PPP can I get ERC if I got PPP? If you know that that's an objection that your organization is having, then that gives you the ability to forward that email. It's just a quick overview, a 2-minute video, and it just quickly summarizes some of the talk today about just that piece. So I'm going to give you tools to be able to give this information, to be able to share it with others. And in your consultation call with Bottom Line Concepts, you can have multiple people. And so it's not unusual for there to be the executive director, someone from finance, the treasurer of the board, whoever needs to be in on that call to ask specific questions about qualifications. If they have any skepticism, absolutely possible. So I'm going to also give you some tools to be able to schedule that call. So only 2 remaining questions and answers. So if you have less than 5 employees, how does this work? That's a great question. So if you have less than 5, you can still qualify. However, the company that I partner with, they require a minimum of 5. So if you've determined through this education that you believe you will qualify, you simply need to find a company perhaps in your area that will work with less than 5 employees. So again, it's not that you're not eligible, it's rather that the company that I partner with requires a minimum of 5. All right, and the next one, is there an ending date to spend the money? No, there is no ending date. It is your money to spend as you will. And can I give a cost range if not an exact cost? So I truly can't give a range because it's based on the amount, it's a percentage of the amount you qualify for. So you don't actually know the rate until it's calculated the amount that you qualify for. I hope that makes sense. So because it's a percentage of an unknown number, I don't have an exact rate that I can quote you. I will say that it is a percentage and it varies. So the higher number of employees you have, the lower the percentages. The less employees you have, the higher the percentages. But how they determine their percentages is unfortunately not something I'm privy to, but it is discussed clearly in the consultation call. They will absolutely disclose that. And it's of course a relevant question to ask right up front. So I encourage folks to do that. All right. And then, do they offer audit protection? That is another really great question. Another feature of working with this company, not only will they prepare the documentation for you, they will keep that documentation. And if the IRS audits you or asks questions, they can supply all of their calculations as to how they determine the amount that you qualify for. I will say that they've done over 30,000 of these. They have had one client audited. It was 2 weeks ago, and they were able to supply the IRS with everything that they asked for, no problems with that one audit out of 30,000. So although it's a legitimate concern, of course, no one wants to be audited, you can expect that this company will be able to provide the information that the IRS would request in an audit. All right, Well, I appreciate your time. I'm really excited about this goal that I have made for everyone collectively, the amount of ERC funds that are going to be applied for because of this education you've received, and hopefully, hopefully we can revisit. I, of course, won't share who or how much they received, but I certainly can broadly let everyone know if we reach our goal collectively. So I am going to pick up these email addresses in the chat and hop over on this other call for those of you who will be joining me there. For those of you who have to continue on with your workday since it's 1 o'clock, thank you so much for your time, and do be looking out for the information that's being sent to you. I'm happy to schedule an additional follow-up call if you have multiple people that need this information before moving forward. It's not unusual for me to make a presentation to a board of directors. So again, if there's someone else who needs this information, please reach out to me and let me know how I can help get you to the process of applying and receiving your funds. Thank you.